Hello, I'm Michelle,
I'm William.
and today we're going to talk about finance. So there are two major laws that exist when you are financing real property. The first one is lien theory, and the second is title theory. New York, for example, is a lien theory state. When you have a lien theory state, the document that secures the debt to the loan is called a mortgage. And the mortgage creates a lien. In the lien, the legal owner of the property is the homeowner or the borrower, and equitable title is given to the lender.
And then there's another form called title theory states, such as Georgia. Georgia is a title theory state in which it's sort of like, I like to equate it to a car, right? You have a title to your car, right? If you own it outright, you have the legal title. If you don't own your property, you haven't financed that car, you have equitable title, and the bank will have the legal title to that property. And home ownership is done the same way. The bank will have legal title, the lender will have legal title, and the homeowner will have equitable title to that property.
And what's the document that secures the loan to the debt?
There's actually two documents. There's a security deed. There's a security document. In Georgia, we call it a security deed. And then there's a promissory note that shows the debt.
Yes. Promissory notes are negotiable, which means, for example, have you ever taken out a loan and then got a letter some days later saying that your loan was sold to another lender? That's because a promissory note is negotiable, which allows the bank to sell your mortgage to another lender or a mortgage company or a bank. The person holding the promissory note is called the holder in due course. In the lien theory state, once the loan is paid off, there will be a satisfaction recorded in the county where the home is located. This takes the lien off of the property and, of course, makes the homeowner the sole legal owner.
Well, in the title theory state, it's somewhat similar. Those two documents that you had earlier, that was the promissory note, which showed the debt, and you had the security deed, which is a live instrument. So when you pay off your mortgage in those situations, there's a cancellation of the security document, so that because it's a live document, it cancels that instrument, so the bank can no longer take ownership of it or possession. And then there's a satisfaction being placed on the promissory note, so that you paid that debt in full. And then there's recorded, and the title will put in the homeowner's name, so they have legal and equitable title at that moment.
Yes, it's done, I believe, through a deed of reconveyance. All right. So what happens, however, if the homeowner does not satisfactorily pay off the debt, instead goes into default? Well, there are two trains of thought, and the first one under lien theory state, of course, is foreclosure, but it is a judicial foreclosure whereby the lender will have to go to court to get granted permission to basically foreclose on the property.
But with the title theory state, it's sort of like your car. I always tell people this: if your car was, you thought your car was stolen and you had paid the debt, you call the police officer and they come out, and the first thing they're going to ask you, are you current with your payment? And just like the lender for that car didn't have to call, didn't have to take you to court to take the car back, the bank does have to do the same thing in a title theory state. They have to give a notice to the world for 4 consecutive weeks that they're going to take your property because of default, because you give them the power sale clause, which is included in the security deed.
There's what's called the equitable right of redemption, which exists in both the lien theory and the title theory. And this essentially gives the borrower an opportunity anytime before the foreclosure to come in, pay up the debt, and secure their property. What's different is what happens after the foreclosure, statutory right of redemption. So a statutory right of redemption is the period in which you can come back after the sale and redeem your property.
Right. And Georgia doesn't have a statutory right of redemption, only except with the case of doing taxes.
Exactly.
So Michelle, let's talk about the Federal Reserve and some more financing information for the students here.
Sure.
So Federal Reserve. The Federal Reserve is a regulatory body that regulates all banks, dealing with all nationally chartered banks and all state chartered banks that wants the protection of the FDIC.
FDIC stands for?
Federal Deposit Insurance Corporation. So now you have the primary market. And the primary market is where the consumer goes to get a loan. The primary market consists of, let's say, banks, pensions, savings and loans. You have mortgage brokers, mortgage bankers, private individuals, things like that.
And credit unions.
And credit unions, absolutely.
All right. And so explain that process of how the primary market frees up money.
Well, the way they free up money is that they sell their loan. So we know that debt is negotiable and assignable. So they sell that debt that they have from the consumer to the secondary market.
And the secondary market consists of basically four major players. The first being Fannie Mae, which prefers FHA, VA, and some conventional loans. Freddie Mac, which favors conventional loans. Ginnie Mae, which prefers FHA, VA loans, and works with HUD as well as subsidized housing, and MGIC, which is an insurance company, but they also play in the secondary market.
So you have three major players. You have FHA, VA, and conventional. So let's talk about FHA.
Okay.
FHA provides a 96.5 LTV loan to ratio value. It also provides a low down payment, as little as 3.5% down. Is there any other things that you know about?
Yeah, sure. So when you have an FHA loan, as a matter of fact, when you have any loan, the lower your down payment, the more of a risk you look like to the bank. So when you have a 96.5% LTV, that means you're only putting 3.5% down, which kind of looks a little risky to the bank. In the case of default, they're worried about getting all of their money back. So because of that, FHA also comes with a mortgage insurance premium. This is a monthly insurance payment. It is not hazard insurance. It's really there to protect the lender in case the borrower defaults.
Perfect. Then you have VA. VA is a military loan that's available to people that was in the military, current serving, or under some type of war time. It provides 100% LTV, but it is very unique.
Yes, it is. While it has 100%, it does not come with a mortgage insurance premium, which is a good thing. Sometimes there is a funding fee charged to the borrower. The only thing is that the borrower has to get a certificate of eligibility from the VA to make sure that they qualify. And unlike FHA, which insures loan, VA guarantees loan.
Those two loan types are for residential properties owned for owner-occupant. Then we have what we call a conventional loan. Mm-hmm. And conventional loan is like what I like to call private money, which typically give you anywhere from an 80 to 95% LTV loan.
Great. Now, again, at 80%, you won't have any insurance premium. However, if you opt to take out a 90 or a 95% loan, again, you're putting down less money, which makes you look like more of a risk. So then you have what's called PMI. PMI is a private mortgage insurance, and so you pay that monthly as well.
And it also allows for an owner-occupant or an investor as well.
Yes.